And your next guest says this is a buy the commodity but maybe sell the company type of environment. Kevin Book is the managing director at Clearview Energy Partners, and he joins us now. Kevin, thanks for joining us. You heard the conversation. The last time oil was at these levels, most of these oil stocks were 50, 75% higher than they are now. They still can't get a lot of love overall. Would you prefer to simply own oil futures?
Yeah, if you look at it, there's a couple of things that are keeping the investment back. You know, part of it is that there's regulatory overhang. If you think about where this could go, there's still a methane pinch coming for the shale patch. There are a lot of questions about how that's going to play out in terms of non-maintenance CapEx or maybe buying allowances, carbon coverage for a regulated market. And another one, we're talking 7% CPI print today, Brian. Everyone's talking about where were you in 1982? Well, remember that in 1980s, we're still in an environment where the inflationary pressure from the oil patch led to windfall taxes. So watch out. It's not just rate hikes, but the tax man who shows up when you see inflation in commodities.
Yeah, well, you also see the regulators, to your first point, Kevin. I mean, we already know that the FTC and some members of Congress have sent some of these CEOs letters talking about collusion, why are gas prices so high, et cetera. There is, let's not forget, a regulatory overhang, to your point. But just how big do you think that overhang might be?
So look, if we look at rig counts relative to WTI's run from trough to peak, we're seeing rigs moving about 1/3 as fast into the oil patch as we saw during the last two run-ups. So with drilled uncompleted well inventories falling, $80 barrel prices, you're going to see drilling. But would you expect to see as much? Probably not with these unsorted issues. There's other things too. When you talk about access to capital, you know, one of the pressure points, the political environment here in Washington, Biden administration maybe can't get Build Back Better, but looking to bring in pressure on cost of capital for companies. Look for regulation on the financial side. And that means that some of what you were talking about, the ESG side. Wow, you found an ESG door back into oil. Well, SEC Chairman Gary Gensler's looking at how funds are defining what they do after we see a disclosure rule for climate disclosures from oil and gas and all companies. Also could see some either guidance or a rule looking at how funds are named.
Yeah, but also, Kevin, and it's a little bit wonky, but I think it's important we talk about, well, why aren't companies producing more oil? Well, first off, there's a lot of reasons. Not all of it is political. To Guy's initial point, these companies want to get smarter. They want to protect their assets. They want to make investors money. But that said, way deep under the scenes, and you know DC as well as anybody, there is a movement to basically prevent Wall Street firms and banks from lending money to have new fossil fuel projects, effectively starve them of capital. So if many of them wanted to do it but had to borrow money, they can't. So there is sort of an unnatural DC angle to why oil prices could go to 100, could go to $1.25 like JP Morgan says.
It takes money going into the ground to get oil and gas out. And to be sure, we're not just talking about a return of capital moment for investors. That has happened. That is happening for sure. Capital discipline. Well, yeah, cost of capital concerns are for real. And the political strategy here, the climate activist strategy, has long been to drive up that cost of capital for fossil fuels. And if at all possible, with the regulatory picture, drive it down for green energy.
Kevin Book, Clearview Energy Partners. Kevin, always appreciate your clear view. Kevin, thank you very much. We'll talk to you soon.
Thanks for having me.
Steve Grasso, go back to you. Like I said, you cut your teeth. Thank you. You cut your teeth, Grasso, in the energy pits years ago. How much would you weight that regulatory or DC or bank risk that we just talked about, if at all?
So the bank risk has been going on for years pre-pandemic. They didn't want to fund a lot of these endeavors by the oil and gas community. But the problem is, I guess the tailwind and the headwind is both political. We're going into the midterm elections. So I don't think that the Biden administration wants to oversee maybe $100, $150 barrel of oil, right? So they're kind of forced here because they want to push alternatives, but you also can't have someone driving a pickup truck or an SUV spending $200 at the pump to fill up the gas. So they're kind of pushed into having a little bit of restraint here. I would say you have to wait, But I think the deeper you get into the middle of the year, the less bullish I am on the energy complex, if that makes sense.